On Thursday, August 14, 2025, the financial world woke up to a jolt. As the sun rose over Wall Street, traders and investors were bracing for another routine day. But what unfolded was anything but ordinary. The air was thick with anticipation, but no one could have predicted the shock that awaited. A government report released before the opening bell revealed that wholesale inflation was surging at a pace not seen in years, catching everyone off guard. The numbers were far above what economists had forecast, sending ripples of surprise through the financial community. Investors, fresh off record highs and a period of relative calm, suddenly faced a new and unsettling reality: rising costs at the producer level. This signaled that inflation, which many hoped was fading, wasn't going away quietly. Instead, it was roaring back, threatening to disrupt the fragile sense of stability that had settled over the markets. The Producer Price Index, or PPI, came in much hotter than expected, instantly shifting the market's mood from celebration to concern. The data was a stark reminder that the battle against inflation was far from over, and that the road ahead could be more turbulent than many had hoped. This single report forced Wall Street to question the health of the economy and what the Federal Reserve might do next. Would policymakers be forced to keep interest rates higher for longer or even consider new hikes? The uncertainty was palpable, and conversations quickly turned from optimism to caution. Just a day earlier, optimism was high, fueled by hopes that inflation was under control and that long-awaited rate cuts were finally on the horizon. Investors were celebrating gains, and there was a sense that the worst might be behind us. But the hot PPI data threw those hopes into doubt, reminding everyone that the path forward is rarely smooth. The market's mood shifted in an instant, as dreams of easy gains gave way to anxiety about what might come next. For everyday Americans, this shift isn't just financial jargon. It affects retirement accounts, job prospects, and the cost of living. Rising producer prices can trickle down to consumers, making everything from groceries to gas more expensive and putting pressure on household budgets across the country. The market's confidence was shaken, and uncertainty took center stage. As investors and families alike tried to make sense of the new data, one thing became clear: the story of inflation and its impact on our lives was far from over. So, what exactly is the Producer Price Index? The Producer Price Index, or PPI, is a key economic indicator that tracks changes in the prices that domestic producers receive for their output. In other words, it measures how much businesses are paid for the goods and services they produce before those products reach consumers. This makes the PPI a crucial tool for understanding inflationary pressures as they build up in the supply chain. Think of it as a measure of inflation from the perspective of businesses, the cost to make the goods and services we all use. When the PPI rises, it often signals that companies are facing higher costs, which can eventually trickle down to consumers in the form of higher retail prices. This is why economists and investors pay close attention to the PPI each month. The July 2025 PPI report shocked economists. Instead of a modest 0.2% rise, wholesale prices jumped 0.9% in a single month. This was a much bigger increase than anyone expected, and it sent a wave of concern through financial markets. Such a sharp jump suggests that inflationary pressures are building much faster than anticipated. Even after removing volatile food and energy prices, core PPI still surged 0.9%, far above forecasts. Core PPI is closely watched because it strips out the most unpredictable components, giving a clearer picture of underlying inflation trends. When core PPI rises this much, it's a sign that price increases are broad-based, not just limited to a few sectors. Year over year, wholesale prices were up 3.3%, the biggest jump since early 2025, well above the Fed's 2% target. This means that, compared to last year, businesses are paying significantly more for the same goods and services. Persistent increases like this can make it harder for the Federal Reserve to bring inflation under control. The main culprit? A sharp rise in service costs, which ripple through the entire economy. When services, from transportation to healthcare to business support, become more expensive, it affects nearly every industry and can push overall inflation higher. Why does this matter for stocks? Rising producer costs can squeeze company profits or get passed on to consumers, fueling more inflation. If companies can't raise prices without losing customers, their earnings may suffer. If they do raise prices, it can make inflation even worse, creating a difficult balancing act for businesses and policymakers alike. Either way, it's bad news for investors, as it could force the Fed to keep rates high. Higher interest rates make borrowing more expensive, slow down economic growth, and can weigh on stock prices. Investors worry that persistent inflation will keep the Fed in a defensive stance for longer than expected. That's why the market reacted so strongly to the PPI surprise. Unexpected inflation data can quickly change expectations about interest rates, corporate profits, and the overall direction of the economy. Suddenly, the inflation fight looked far from over. The PPI report served as a wake-up call, reminding everyone that inflation can be stubborn and unpredictable, and that the road to price stability may be longer and bumpier than hoped. The market's reaction to the PPI shock was immediate and dramatic, sending ripples of concern through trading floors and newsrooms alike. Even before the opening bell, stock futures tumbled sharply as traders scrambled to process the unexpected inflation data and what it might mean for the economy. S&P 500 and NASDAQ 100 futures both dropped 0.4%, erasing overnight gains and setting a negative tone for the day ahead. The Dow Jones Industrial Average also took a hit, falling by 158 points in pre-market trading as investors braced for a volatile session. The sell-off was broad and swift, hitting companies that are especially sensitive to economic shifts and rising borrowing costs, as fears of persistent inflation took hold. Deere & Company, a bellwether for industrial demand, plunged over 7% in pre-market trading, reflecting worries about the impact of higher costs on corporate profits. Even tech giant Cisco slipped 1%, despite reporting decent earnings, as the market's focus shifted from company results to the broader economic outlook. The VIX, often called Wall Street's fear gauge, spiked higher, signaling a surge in anxiety and expectations of increased volatility in the days to come. Investors quickly repriced their expectations, coming to terms with the reality that the dream of an imminent rate cut by the Federal Reserve was rapidly fading. The red numbers flashing across trading screens weren't just statistics. They reflected a sudden and widespread loss of confidence, as hopes for easy money evaporated. For months, the market had bet heavily on falling rates, fueling optimism and risk-taking. Now, that bet was in serious doubt, leaving many investors disappointed and uncertain. The PPI report forced everyone, from Wall Street analysts to Main Street investors, to reconsider their assumptions about inflation, interest rates, and the path forward. In a matter of hours, uncertainty had replaced the calm of the previous day, leaving markets on edge and investors searching for answers in a suddenly unpredictable environment. The shock from the PPI report was amplified because it clashed with the Consumer Price Index, or CPI, released just days earlier. The CPI, which tracks prices paid by consumers, had shown inflation holding steady at 2.7%. A relief for markets. That cool CPI reading fueled a rally, as investors believed the Fed could soon cut rates. But the hot PPI told a different story. Producer costs were rising fast, hinting that consumer prices might soon follow. This disconnect left investors confused. Should they trust the calm CPI or the alarming PPI? The divergence made it much harder to predict the Fed's next move. Suddenly, the simple narrative of falling inflation and easy money was gone. The market was left with more questions than answers. Uncertainty reigned and optimism faded. The conflicting inflation data put the Federal Reserve in a tough spot. Just days before, markets were nearly certain the Fed would cut rates in September, with tools like the CME FedWatch showing a 99.9% chance. The cool CPI had cemented that belief, fueling the stock rally. But the hot PPI upended everything. A 0.9% monthly jump in wholesale prices is not what the Fed wants to see. Now, cutting rates looks risky, as it could reignite inflation. The market's confidence in a September cut evaporated almost overnight. The Fed faces a dilemma: support growth and risk inflation, or keep rates high and risk slowing the economy. This uncertainty is why optimism turned to anxiety so quickly. Investors experienced emotional whiplash this week. Euphoria one day, anxiety the next. On Wednesday, the S&P 500 and NASDAQ hit record highs, driven by hopes of rate cuts and stable inflation. The mood was confident, portfolios were positioned for more gains. But less than 24 hours later, the PPI report shattered that narrative. Suddenly, the path to easy money was blocked, and the market's foundation looked shaky. The abrupt shift left investors disoriented, forced to question their assumptions. It was a stark reminder of how quickly sentiment can turn in financial markets. News and data can change everything in an instant. The journey from optimism to concern was swift and sobering. Complacency gave way to caution. When markets get rocky, experts say, don't panic, focus on fundamentals. Diversify your portfolio across stocks, bonds, and cash to cushion against shocks. Consider safer assets like high-quality bonds or products with downside protection. Manage your expectations. Volatility is normal, and recent calm may not last. Stick to your long-term plan, rebalance as needed, and avoid trying to time the market. Regular contributions and dollar-cost averaging help smooth out the bumps. Emotional decisions rarely pay off. Discipline is key. Building wealth is about patience, not reacting to every headline. It's easy to think Wall Street news doesn't affect you, but market swings hit everyone, especially through retirement accounts like 401(k)s and IRAs. When stocks drop, so do the values of these accounts, impacting your financial future. For those nearing retirement, a sudden downturn can be unsettling. For younger investors, it affects long-term growth. The stock market's health also signals the broader economy. Weakness can mean fewer jobs and slower wage growth. Rising wholesale prices often lead to higher consumer prices, shrinking your purchasing power. Understanding these trends helps you make smarter financial decisions and avoid panic. You don't need to be an expert, but knowing why markets move empowers you. It puts scary headlines in context and helps you stay focused on your goals. Informed investors are confident investors. Looking ahead, investors will watch inflation data closely. Will consumer prices catch up to producer costs, or was the PPI spike a fluke? The Federal Reserve's words and actions will be scrutinized for clues about future rate moves. Corporate earnings and forecasts will reveal how businesses are coping with rising costs and shifting demand. For everyday investors, the best move is to stay patient, stick to your plan, and avoid knee-jerk reactions. Volatility may continue, but wealth building is a marathon, not a sprint. Keep your portfolio diversified and your focus long-term. Stay informed, but don't let headlines drive your decisions. With discipline and perspective, you can weather whatever comes next.